Good afternoon. It's 12 noon on Friday, the 16th of October. I'm Jeff Christian from CPM Group. I have a couple topics I wanted to cover today. First thing is, let me briefly bring you up to speed on what we see in the precious metals markets. Gold is trading around $1,900, a little bit either side of it the last several days. I had fallen sharply in mid-September, and then it rose back almost as sharply. And it's treading water. Silver is more volatile, but it's continuing. Palladium continues to be very high, and platinum continues to be very low. Our view has been and continues to be that there's a lot of issues that could drive gold and silver prices higher over the next 2 weeks, 2 months. We were saying 4 months, 2 months ago, and going forward. First off is obviously the election in the United States, which could be extremely volatile and disruptive and cause people to want to buy gold and silver as a safe haven. In addition to that, we have a number of ongoing crises that are not getting better, but actually are showing signs of petering out and maybe getting worse. The first one is obviously the COVID-19 pandemic. We're seeing a sharp increase in infection rates in the United States. We're seeing a sharp increase in infection rates and deaths in Europe. There are problems in Latin America, Africa, and other parts of the world. The COVID-19 pandemic is not going away. There are issues that will delay the vaccines, and it's not quite clear how effective the vaccines will be if and when they come out. So the pandemic is going to continue to be a problem, and it's going to worsen at least over the next 3 to 4 months. Similarly, the economic environment continues to be problematic. We saw a sharp decline in global and US GDP and economic activity in the second quarter of this year as the world shut down in response to the pandemic. We saw the beginnings of a rebound. Some people would say a dead cat bounce in the third quarter. And now things are slowing down. They're slowing down in the United States, in Europe, and in other parts of the world. Economic stimulus package coming from the United States is highly unlikely to be seen for the next several months. It definitely won't emerge before the election, and it probably won't emerge in the period from November through January, where we may or may not see a transitional government. So we don't see help coming from the US government in terms of economic stimulus. We see, the way I described it earlier this week to a client was that we're knee deep in mud, and the only way out of it is to push forward. So I think the economic and financial market conditions will be supportive of investors buying gold and silver over the next several months. There's a December roll coming up for December gold contracts. Last time I looked a couple of days ago, there were 44 million ounces of open interest in December. Once you get into late November, after the election, those shorts will be rolling forward. They'll be buying back their Decembers, applying some upward pressure on prices and selling forward. It'll be very interesting to see which forward month they choose to roll into. Probably it won't be February. My guess is it might be April. You'll also have some seasonality. The prices of gold and silver tend to be strongest in the period January, February, March, and that may kick in too. So we may see gold and silver prices rise, move out of the sort of base building that they've been doing in the last 4 weeks or so, and they could rise sharply over the next 2 weeks and then over the next 2 months. Basically what we've been saying for about 2 months now. The second subject I wanted to talk about relates to this piece of paper here called Apples to Apples. And it's not related to precious metals, it's actually across financial markets. And Institutional Investor Magazine last year, or the year before, had a great article, I guess it was late 2018, on the bad math that circulates in Wall Street and US financial markets. There's a tremendous amount of bad math. And I remember talking to my one son, who is actually a scientist at NASA, about some of the mathematics. And he said, well, one of the problems is that people try to apply math to arithmetic. You see this across financial markets. It's not uncommon that people will take, for example, the price of gold and run a correlation against interest rates. And that's apples to oranges. It's a price level versus a price level, because the interest rate is in fact the price of a loan. The proper way to do it is to look at real inflation adjusted prices and say that what's the change from period to period in real prices versus what's the change in interest rates. And you'll see any number of very well-respected analysts and commentators in the gold market will say, oh, the correlation between gold and interest rates is 38 or 78 or 50%. They have these outrageously high correlations. If you do your statistics properly, apples to apples, percent change in gold prices relative to percent change in interest rates, the correlation is zero, which is one of the reasons why gold's so interesting to investors. It's uncorrelated with interest rates. Yes, you can find times when interest rates are rising and gold is falling. You can find times when interest rates are rising and gold's rising. You can find times when they're both falling. You can see times when gold prices are rising and interest rates are falling. Over time, the correlation measured properly using arithmetic is zero. And it's amazing how bad the arithmetic is in the gold market. And to be honest, going back to the early 1980s, Intergold, which was the South African predecessor of the World Gold Council, hired Woody Brock, who was a very well-respected economist at a university in California, to build a gold pricing model. And he used nominal prices, which is just, and he said, wow, there's a very high correlation between nominal prices and inflation. Of course there is, because a big component of nominal prices of any asset is inflation. You got to take the inflation out and look at real prices to see what the inflation effect is on a market. I have a chart here, two charts here, and it prompted me to think about this week because somebody published a chart on the left showing gold, silver prices versus silver ETF holdings. And they said, well, that chart is intended to show you a very high correlation. Oh, the silver prices are rising because people are buying silver ETFs, or maybe people are buying silver ETFs because the price is rising. But it's intended to show you a very high correlation. And to their honor, they have scales that are 0 to something. Oftentimes what you'll find is people will play with the scales. So one of the variables will have a scale of say 40 to 80, and the other one will have a scale of 200 to 1600. So you can play with the scales so that the charts the two lines look similar. I put a table, the chart on the right is from CPM Group, and it's looking at the percent change in silver ETF holdings versus the percent change in silver prices. And you can see it's a little bit crowded. There's not much there. The table up above shows you over 4 periods of time the correlation of changes in silver ETF holdings and silver prices, apples to apple, and apples to oranges, the changes in ETF holdings versus silver prices. Again, ounces to dollars. You're not comparing apples to apples, you're comparing apples to oranges. And you can see, over the period of time from 2006 till October 7th, a couple of weeks ago, you can see a 5.5% correlation between changes in interest rate, changes in silver prices, and changes in the ETF holdings. That's a pretty low correlation. And you can see that if you look at just like say 2020, this year to date, it's about 19%. And then you get these outrageous numbers, including a negative 22%, if you're looking at apples to oranges. Of course, those of you know us and follow us, you know that in early September, we wrote about and spoke about in a video the fact that a lot of the silver and gold that has poured into the ETFs this year, about 300 million ounces into silver ETFs this year, actually doesn't represent investors buying silver ETFs because they want exposure to the silver price. It actually represents the declining liquidity and trading activity in the local London bullion market. And you have any number of banks that were net buyers of gold and silver really over the last 3 years, but then it got very intense in March and April when there was a tremendous amount of gold and silver that was sold back to the market, back to market making banks and bullion dealers by investors who wanted cash. And that gold and silver showed up on the bank's coffers just as senior management was saying, we want to cut back or get rid of our precious metals trading departments. And what we've seen from March until a couple months ago is that some of those banks took that physical gold and silver and sold it for ETF shares. So you got about 29 million ounces of gold ETF additions this year, about 300 million ounces of silver. And a lot of that actually, we don't know how much yet because it's all secret, but a lot of that clearly was not investors buying gold and silver, but rather banks getting rid of gold and silver and exchanging it for ETF shares, which then go into a different bucket in their account, in the bank's overall accounting system. So we've staked our claim on doing well with research and getting the markets right. And that involves having good data, good market intelligence, and good analysis. So you get the good data and you don't screw around with it. And then you have good market intelligence. So you say, wow, 300 million ounces of silver. That's a lot of silver. In fact, investors have never bought 300 million ounces of silver. There are some silver promotional agencies out there who will say that they have, but their data is garbage. Bad data, bad analysis, bad market intelligence. We see this data, we say 300 million ounces. We'd like to have an explanation as to who's doing this buying. Good market intelligence, you go off and you find out that these banks have sort of had a gun put to their head and say, get rid of some of this gold and silver. And then good analysis. What's that mean? Well, it actually is kind of positive for gold and silver because if the market liquidity is drying up as market makers either get out of precious metals or severely reduce their transactions, what you'll see is probably more volatile prices and the possibility of prices moving higher when they're moving higher, moving lower when they're moving lower. Going back one step to that market intelligence, as we're working with our clients who are buying gold and silver, what we're finding is that the remaining market makers are really aggressively working, bidding for business. And that tells us what we've seen with this data earlier, which is that the markets have plenty of gold and silver. And you can see it in the data. Record amounts of gold and silver stored in London, in Zurich, in New York. The market's well supplied, but the liquidity, both the depth and the breadth of the trading capacity is changing in a way that is less conducive to getting good prices and effective prices. So that is the comment that just came up. And when we have several people who ask us about data that they're seeing in the market and we have to explain it, we find that if we put out a video like this and explain it, then we can get back to other work and not have to keep explaining bad data and bad analysis that people are asking us about. Take care of yourself, take care of each other, keep your hands clean. If you're in New York, don't get soaked in this rain that we have today, and I'll talk to you next week.